So I think thank you very much. Let me start this presentation with a welcoming note to every participants who have been participating for this particular event. And I'll make sure and I'll ensure that whatever we are going to discuss, and that's what my theme has always been in a presentation, that I be very crisp and I'll be more relevant to the topic and I'll be more trying to cover the pointers which is important from a day-to-day business activities which we have been doing. Let me also, before we start the presentation, thank my team who have been spending good amount of time doing research to identify good content which is useful for everybody who has been participating on this particular presentation. With this thank you note, I'll start this presentation, and what I'm going to cover today, let me brief you about it. What I'm going to cover is basically uh, what are the litigations which are going around in relation to the share transactions uh, when it comes to unexplained investments, so where your penny stocks matters have been there. That's one detailed topic is what we are going to cover. The second detailed topic which we are going to cover is what happens in case of investments which happens in shares. So for from NRI taxation perspective, from AIF perspective, we'll be discussing about that. So in and all, in 1 hour, we'll be having a power pack presentation in terms of number one, section 68 additions which are going out in penny stocks, whether they are penny, non-penny, but still there has been a lot of additions. So I'm going to have some interesting discussions which is going to be in and around that. Number two is NRI, when they invest into India, what should be their taxations? And that's what we are going to cover. Number three, what we are going to cover is something related to AIF. Now let me start straight to the point. Basically, from the taxation which is in relation to Section 68 additions. Now you'll be seeing that there is a lot of situations where there are a lot of situations where you will be seeing that there has been huge amount of additions happening in relation to Section 68. Now, this Section 68 is basically from a perspective that uh, every individuals or every firms who have invested into stocks which has a huge frequency in pricings and who has been having a volume discounts, volume transactions. All those transactions have made a huge amount of profit, or they have made losses. Now, what has happened is in income tax, everybody have been scanned under one particular scanner, where everybody is been asked to pay tax on the tradings which have happened in penny stocks. And no matter whether it is really a penny or non-penny, but basically there have been a lot of litigations which is going around either to justify that there is no penny stocks, and there is a lot of efforts which have been going around to justify that. Now, what I'm going to cover in relation to it is basically what is the SOP saying. So there has been an SOP which has come out by the CBDT, and that SOP is what we are going to discuss today. So as to what are they trying to cover, or how are they guiding, how CBDT is trying guiding the administrative office on how this particular uh, Section 68 unexplained shares or penny stocks should be dealt with, and how this assessment or the appeal matter should be handled in relation to that. It's a very interesting thing. When we are going to go into the details of that, you will really understand that how CBDT is guiding it and how it is actually happening on the execution side when it is a matter of assessment or appeal. The first thing which CBDT is saying, that issues in hand to be proved by the AO. So what it's trying to say is that whether this is the shell company or not, whether there are no, the CBDT is asking the assessing officer to scrutinize whether the company which is considered to be a penny company, whether they are actually a shell company, whether there are no assets, suspicious price movements. So uh, are functioning or reacting in that particular manner. What is the KYC brokers who have been dealing with it? What are the KYCs which are happening in relation to that? Are there any violations to it? Uh, Second is regulatory actions. Have the SABI has taken any actions? And this has been very important. And we'll be discussing that in detail, how the SABI's orders are supposed to be dealt with in such kind of a situation. Financial trails inconsistency. So if there are any inconsistency in and around that, that should be taken care of. Uh, through is there any backward transactions which have got executed, so we'll be dealing that also, that if there in is there any backward trail which is there in relation to this transaction. So that's what we'll be discussing. So CBDT is trying to look it from all this perspective and saying to the assessing officer that you should be looking from all this perspective. Now, what is basically identifying the bogus? So the taxpayer reports disproportionate large long-term capital gain or maybe a short-term capital loss. Long-term capital gain in past because was exempt, so there was of course a lot of entry transactions which had happened around in and around that, and therefore that is one of the area which is covered under the scanner for one or two volatile scripts. So what happens is generally they don't deal with multiple scripts. The all this kind of a capital gain, huge amount of capital gain or losses have happened into maybe two or three scripts. So what CBT is saying that that is basically a trigger point. So you need to look at that whether they have dealt with only one or two scripts in that particular year. So that's one has to be reviewed upon. What has been the pricing fluctuation? So there's a bell format wherein at the bottom you are buying it, at the top you are selling it, and somebody at the top is entering it for making a loss and selling it at the bottom. So there's a bell theory which happens wherein at the bottom it is bought, at the peak it is sold. So there's a profit, long-term capital gain profit. Somebody enters at the top, and that is the time when he enters, and at the again at the bottom he sells. So basically, he makes a loss. So somebody makes a profit, somebody makes a loss. That's the story, and that's the game which was happening. So they are trying to say that whether the fluctuation in the price has been of that particular pattern, and also let me go to the next one. The next one, it says gathering the information from public domain. So what is the financials are talking about? This is what all the CBDT is saying to the assessing officer to look into. Now, what is important for us? The important for us is that we need to check whether officers have really spent their amount of time and efforts in understanding this. Have they evaluated and calibrated all this efforts, all this guidance? Have they calibrated and brought out in the order before finalizing that this particular stock is a penny stock or this transaction is a penny transaction? So whether that level of efforts have been spent or not is something has to be looked into. Largely on a practical side, if we see orders, largely what have been prepared. I'm seeing many orders which have also where this kind of a detailed efforts have gone, but there have been many cases where I'm seeing that the efforts are only a copy paste efforts wherein there's a standard stereotype order which is already there, and the same order has been placed into different other orders. So there have not been able to in there is no presence of any efforts which is guided by the CBDT which has been spent, and therefore that becomes a very important point when you are litigating that particular matter or defending that particular matter, to present it in that way that all these efforts have not been spared in spite of being guided by the CBDT. Now, there may be a question which might be coming up in mind that Darshak, when we are aware of that the client who have done the transactions are really a penny transaction, and he has actually made the transactions only to make profit or loss and to save tax. Now that is one kind of a transactions where it is very sure shot that it is a penny stocks and there's nothing best what you can do out of that. That's one kind of a transaction where I'm not dealing it right now on that side, but I'm dealing with lot of such matters which I'm seeing coming across on my table itself, where client is very clearly saying that Darshak, I have not done anything wrong, and there's nothing. I have come across one case where there has been a volume of business which is done with a script where he is not having any malified intention. He has done a real transaction. But in such kind of a transactions also, the tax has been somewhere around 68% tax which has been levied. Now, those are the transactions which have come across in a genuine format, but still they have got trapped into the so-called penny stock transactions and the tax have been levied. Now, this whole presentation is made from that perspective that those non-malified transactions which have got trapped, how do we remove them from the trap? So that's the purpose of this particular presentation. So please don't correlate it with the transactions where we all are aware of that it is a penny transaction. Of course, we should not defend that transactions. This is purely from a non-manified transactions which have got trapped into the penny transaction. So when I'm going to the next point, what CBDT have said that gathering the information to be collected from the assessee. So basically what is his past experience, what are the instances where there has been such kind of an extraordinary income or loss which has happened in past, what is the regular nature of the business. There have been instances where the summons have been issued, wives have been called to record the statement on oath, and wives have given a statement that they are not aware about these transactions. Now, this has happened because husband might be dealing in those transactions, but wife was not aware of, and therefore she could not give a right presentation in the statement recorded, and therefore that have also been one of the instances. So CBDT is saying to record all this particular thing. Related activities, if suppose related entities, so if there is a transactions which is happening from one particular company where there is a purchase, in the second company there is a sale, and therefore there is a profit and loss getting booked. So such kind of a transaction is what the CBDT is saying you have to consider. Information to be gathered from other sources. So what are the other sources is demat records. You can also, CBDT is also guiding the officers to look into the trading information which can be extracted or borrowed from the regulations. So getting all the details to check how much volumes have happened on a particular date, when somebody have actually purchased at a lot, somebody have actually sold at a lot. So is it that such kind of a transactions fictitiously have been very visible, that okay, the person who has been regularly buying the shares and regularly selling the shares, they are the same people who are coming at the right at the same time. Now this information we are not it's not accessible to us, but at a department level this information is accessible, and therefore CBTT is saying that you should get into all this information to study that what is the background story about the transactions which is qualified to be a penny stock. Now, in the genuine transactions, it has not been like that, where somebody have when he's purchasing, the opposite person is the same person who is always selling. So there that kind of a linkage is something which is not available when there is a genuine transaction. So therefore, you need to get those info. Which you should ask the assessing officer to get those information. Go back to the regulations to get that information to see that when it has been traded, who have been the buyer, who have been the seller. The backtracking activity cannot be done by us, but by the department it can be done. Now let me now go to, this is what something which the CBDT have said in the SOP. I have just given a complete crux of it. The team have given good amount of efforts to prepare the crux of it. The crux is basically that officers should work upon and get into all this information to decide whether it is actually a penny transaction or it is not a penny transaction. Now we go to some rulings, and what is the rulings trying to say? So I'll summarize the ruling. So ruling is saying that check whether the fundamentals are weak or not. Fundamentals of the company which has got traded. There have been, when it is malified, you are able to see that there is no possibility of there being a valuation attached to it, or there is no possibility of there being a surge in the price. However, when we dealt with some cases, we have come across a background stories where there were some acquisitions which were planted, and since there was acquisitions which were there in the plan, and therefore the valuation had got surge, which we could present it or demonstrate it, and therefore the fundamentals are supposed to be looked into. And it is not, see, one more thing which I would bring it out over here is generally when we see the financials, as a consultant or as an officer, we'll see the financials whether it is profit or loss, and if it is a loss it is fundamentally weak. Actually that's not the fact, because nowadays when we are seeing a lot of fundamentals which are dependent on the story, right? So what is the story, underlying story which is lying? So there have been a situations where the underlying stories plays a very important role. Now that is something which should be identified. Now, one case where we came across, we saw that the first parameter which we saw was that the valuation had got surged in the price. Now, we get some of the other fundamentals which supports the transaction. Now, in one of the case, we found that okay, in case of a trading transactions where it's a derivative trading, we came across a situation where there was a pattern. So there was a pattern in the surge in the price when it was coming near expiry. Now this pattern was something which was found it regularly. So there have been regular transactions where this patterns regular period where this pattern was found that near the expiry the price gets surged. Now this became a part of the fundamental saying that this pattern has been identified by the client and therefore the client has indulged into this transaction. So though it may be classified to be a penny transaction, penny stock, but ideally the transaction is not penny because fundamentally this is the reason why company why client entered into the transaction or and made an exit. So that is something which we need to prove. SEBI is playing important role. We'll come across on some cases which are said that where SEBI, to what levels, if the SEBI have indulged into a due diligence of that script to classify it to be a penny stock. So we'll discuss that. Investigation report. What is the investigation report trying to say? We'll discuss that about. And courts. What this slide is trying to say is that we need to look into courts. What is the court trying to say? So these are the areas where courts have said that these are the areas which should be looked into for determining whether it is really a genuine transaction or a non-genuine transactions. We'll deal with each one of it, and the case laws is what I'm bringing it up on table for you. The first one is what is fundamentally weak. So we'll be discussing all of them. There are approximately 4 points which we want to cover, and the case laws related to it is what we are going to discuss. Fundamentally weak transactions. Now, here what happened is if you see this, the officer's own finding shows that increase in the net worth, book value, and EPS, which indicates that the company is improving in the financial positions. This is what the courts have observed. The assessing officer failed to appreciate the positive indicators which weakened the conclusion that it is a penny stock and with no intrinsic value. So this was the case which was in favor. Now the second Zomato case. The Zomato case also had the similar issue because it was making losses. The example of the shares of Zomato, despite having losses, basically it was traded at a considerable value. Okay, where the price was getting picked up. So the performance of the Zomato for India 22 was worse than the performance of 21. Despite this, the price was increasing. This is what I was trying to say, that does not matter whether it is a loss-making company or not. What is important is the underlying story. So in the same example, Zomato also, where this got trapped, then the question was that why there is a surge in the valuation. So here also there has been an inquiry which was there, which was answered that there is an underlying story which is important, should be looked into. Now, next one is SEBI. So what is SEBI trying to say? So in the SEBI related cases, what is it saying? What are courts saying? The court is saying that the allied direction issued by SEBI are not available in public domain. Okay, the if AO has not brought on record what those allied directions were and how appellate was connected with the same. The allied BAC notice is also not available in public domain. The AO has not brought on record any material to show that the allied counterparts were also parties to arrange transaction. It is not the case of AO himself that any actions has to be taken by SEBI or the income tax department against any of these allied counterpart. So here, though the assessing officer was trying to take the back support of SEBI order, what the courts have said that those orders are not specifically saying that this is classified to be a penny transaction, and just bear a note of a transaction does not make it to be a penny transaction. That's what the courts have said. SEBI, there is another case which is saying in this background, the only logical recourse would be to place reliance on the orders placed by SEBI, pointing out the malified practices by certain parties and taking action against them. In this case, no adverse inferences in regards to the script was in context of SEBI report. So there was no adverse inferences which was made. Find places in the assessment order or CIT appeal order, and thus the transaction carried out by the assessee cannot be termed as bogus. So, though there is a note which is there from SEBI, but it is not giving an inferences or it has not qualified this to be a non-traded transactions or an penny transactions, and therefore the courts have said that just because there is a note, it does not make a transaction to be a penny transaction. Going on to the third part, which is investigation report, and how do we have the direct nexus of that? The courts have said that the stock price movement alone could not be ground to hold transactions as an accommodation entries. Just because there is a price movement, you can't say it. The department was required to establish the nexus between the assessee and the allied manipulations. So remember, I told you that in one of the cases, the courts have gone to the point that you prove the nexus. Just because the price have got surged up, it does not make assesses transaction to be a qualified. So, for example, I said an example of a derivative where near the expiry, the price used to surge and somebody entered into it and took the benefit of that. Now, frankly speaking, it's a skill, right? In the share market, this is a skill wherein you are able to identify the right time and the right time to enter and right time to exit. It no matters which script you are dealing with, right? So that is what it had happened in this case, and therefore the court said that you need to prove the nexus that there was something wrong indulged, okay, or wrong intention which was there. Just because there is a price fluctuation and assessee has done a transaction at that particular time, it does not consider that it is a non-genuine transaction. The next one is AO made addition allied involvement in penny stocks which were being misused for providing bogus accommodation of long-term capital gain. However, there was lack of adverse comments from stock exchange. So there was no adverse comments and officials of the company involved in this transaction, and no material relating to assessee was found in investigation wings also. Addition made by AO has rightly been deleted. So there is no such inferences which was brought. Contract notes, yes, these are all the traditionally running cases where they have courts have said that if you have been providing all the documentations which are demat accounts, bank statements which shows that the transactions of purchase were at the right time, if you are providing all these informations, all those documentations, basic documentations which we all are aware of, then that also plays an important role to prove that the transaction is a bona fide transaction or a genuine transaction. Now that does not matter, that does not mean that every time when you give this documentations it proves to be a genuine transaction. So I have come across lot of matters which now is before CIT appeal and tribunal, but at an assessment level, only contract notes, bank statements have been provided, and then it has been said that this documentation proves that it is a genuine transaction. Frankly speaking, that would not work, because just because there is a demat statement, there is a bank account and contract note, that is not going to prove the transactions to be a genuine transaction. Please, 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 my urge request is that please at an assessment level try to get involved as much as possible to prove that why this transaction is not a malified transaction. See, by giving documentation you might be saying that okay, my evidences are there, but you need to prove that there is no malified intention. That is very important, which plays an important role when you are at a tribunal level. Next is, it was noted that assessee has submitted all purchases, sales bills, contract notes along with this ledger. So that's all the documentations which were submitted. Courts in previous situations were allowing it, but nowadays they are going into the intentions. What is the intention? Basic information, again, the same thing which has been mentioned over here. I'll just read the last one, which is saying it was noted that the transaction of allotted shares was off-market transaction and not carried out through an exchange. Since the said company was a penny company and the financials and the trading pattern of the accommodation entries by allotting shares to the beneficiaries, action of assessing was nothing but pre-motivated con conduct done for converting its unaccounted money. So this transactions where the money was not paid, the purchase price was not paid through a bank details, but it was a cash transaction which was executed, which we are aware of the purpose of doing that, and therefore the courts have sensed out and it said that it is not a bona fide transaction. Penny stocks are fundamentally weak. So the financials indicated poor results that were not commensurate to steep increase in the price. Now, these are the cases which are against SSC and it is in favor of revenue. Why they have said it, I'm just bringing it up for your references that also appeared in the list of 84 penny stocks listed with BSE, which was found to be managed by the unscrupulous brokers, entry operators, and it is therefore a bogus transaction straight away. Now, what we need to do in these situations? What are we supposed to do? That is what, let's discuss that. That in such situations, what are we supposed to do? Now, here, what we should be doing is we need to see that what is fundamentally weak. So we need to try to see, we need to play a reverse mechanism role. Our job is to say that this is not a penny, this is not a malified intention. That's what we are supposed to prove. Now, how do we do it? So first is fundamentally weak. So like companies like Zomato, the example of Zomato, which I said, the example of derivatives, which I said, believe me, the kind of efforts which was spent on it to identify the pattern, it was, if I would have spent that pattern in actually doing that transaction, I would have made more profit. But nevertheless, at the end of the day, what was important is that to find out the pattern which was helpful. So this, something of this kind of an exercise had actually helped to prove that the transactions is fundamental, the transaction is not malified, the transaction may be into a script which is a penny script, but the transactions is not malified. So that is something which we need to get into. SEBI, check if SEBI has actually delisted the company, because there have been lots of instances where assessing officers have considered the support of SEBI note, and they have said that SEBI have also blacklisted. But believe me, there have been a lot of situations where SEBI have actually not delisted the companies, or SEBI have not blacklisted the company. They have just given a passing comment, or they have given notes, or they have given an investigation notes for doing an investigation, but that does not result that that is a blacklisted company. So we need to see the backstory, whether it is actually a suspended stock or it is just a note which is for investigation. Investigation reports and direct nexus. Also, one more important thing from SEBI perspective, what needs to be looked into is when you entered the transaction at that point of time, what was the situation of that stock, whether that was blacklisted, that was delisted, that was suspended or not. Because if that was not suspended at that point of time and the transactions was executed, later on it getting suspended, you still have a case. I'm not saying that you have a complete case just based on this point, but yes, you have a case because at the time when you transacted, it was not suspended. Investigation report and direct nexus, officer must prove, this is the onus on the officer to prove, the officer must prove the direct nexus between assesses and the price fluctuations. Data, of course, we spoke about. When reverse proving is not possible, so let's say if it is not possible after studying the case, if you understand that reverse proving is not going to be possible, then maybe you need to leave that particular case saying that it is a penny stock. But if you have the possibility of going on to all these four parameters, then it is a case which you should fight for. Okay, I'm done with this is summary of it. Whatever we have spoken, this is available for you. You can of course go through it, and there's a benefit for the benefit of people. It's a summary. You can take a photo of it for your references, right? Before I go to the next slide, if somebody wants to take a snap of it, they can always take a snap. We can move forward. Okay, moving forward to the next part. Yes. Now, this is again an important point which everybody should make a note. Somebody who is not attentive or may not be available right now on the screen, they can also make a note of it. It's very important. So therefore, I'm just making a remark. So this is basically for a UAE resident, whether the mutual fund gained is taxable or not taxable. Now, this is important right now to look into, because for a UAE resident, what is what is the important role? The important role is to check whether the mutual fund gained, whether it is going to be taxable or not. Now, if you go to income tax, of course it is taxable. When you go to DTAA, what DTAA says, there are four clauses. Out of the four clauses, first three clauses are talking about other assets other than mutual funds. There is no specific provision which is talking about securities uh, in that clause. It refers to shares. So mutual funds not being shares, therefore it does not get qualified under first three paragraph, which ask the India to collect the tax as per the DTAA. So it falls into the residual clause, which is fourth clause. Under fourth clause, it is the resident country which has a right to tax. So therefore, by making this point, it makes it say that if we go to DTAA, as per income tax, it is taxable. Okay, mutual fund gain for a UAE resident is taxable as per Income Tax Act. But when you go to DTAA and you take a reference of it, because of clause 4, which is saying that all the other assets is going to be taxable in the resident country, in therefore, as per DTAA, India does not have the right to tax that transactions. Now, this is something which is there going across long way. There are a lot of financial advisors who are playing very crucial role right now to bring this point to the investors, and there's a lot of things which is going across in this. Currently the shape is bad as far as market is concerned, but otherwise this is playing an important role. Mutual fund is not shares, as I spoke to you. There is a decision on that. The same clauses is also there in Singapore and Mauritius. For Switzerland, held that the gain will not be taxable. India is equity-oriented mutual funds are not shares. So this is also one important case. So there are series of such cases where they have said this. Uh, this will be applicable when units of AIF sold. So now, what is important to look into is whether when you sell the units of AIF, whether the same provisions would be applicable or not. So answer to my knowledge right now, because you are considering it to be the units. Okay. So you're classifying it to be into the same category. But if it because it clearly says shares. So when you talk about shares, if you're dealing in shares, then shares will be there. If you're not dealing in shares, then it is going into the residual clause, and therefore the effect of mutual fund will also be applicable to this particular units of AIF. Okay. Now notional loss. Now this is also very critical when you look into from a US resident perspective. So we spoke about UAE. Now we speak about US. Now from a US perspective, this plays a very important role. Now in US, what happens is domestic law says that if you are paying tax in, if you are a tax-paying citizen of US, then even if you have a mutual fund in India, your mutual fund are not classified into a particular category, and therefore that will be taxed on a year-on-year basis, on a notional basis. So let's say in India you earned mutual fund profit, uh, then it is, of course, if you have redeemed it and you have realized the profit, then you are paying tax in India, you are paying tax in US, and you are getting a credit over there, right? So you're not double taxed. But let me take an example where in year one, you in mutual funds, India has not paid tax. So because it is not realized, there is a notional profit. US will tax that notional profit in year one. So in year one, you have already paid tax in US. Now in year three, in India, when you realize it, okay, you pay tax on a realized long-term capital gain or short-term capital gain. So you pay tax at that point of time on those mutual fund gain. But year three in US, again, it won't be taxable. So in year three, since you are not taxed again, therefore there is no credit which you will get in year three. So there is straight double taxation. Year one, you paid tax in US. Year three, you are paying tax in India, and you are not able to forego the credit. So that is one problem which is there currently. Now, one of the alternative solution which can be looked into is that when you are not doing or executing this transaction at an individual level, but you are executing this transaction at a entity level. So if you're doing a transaction at an entity level, because it's an independent entity, it is not in link with the individual, therefore the taxation elements changes, and therefore as an individual, since you are citizen of USA, transactions which have been executed by entity will not be double taxed. So that's one of the alternative which can be looked into for avoiding this double taxation, right? Okay, moving to the next. Okay, now the next question which lot of what happens is that if you see the structure, the structure is defined. Let me give you that. The structure is such that there is one decision of Karnataka High Court which is saying that it should be at a gross value. The tax should be deducted at a gross payable amount. Okay. Now the question is whether it should be net or gross. So let's say the sales consideration which you receive is 1 crore. The cost, which is a direct cost of the particular asset, acquisition cost, let's say is 45 lakh, or maybe 55 lakh. So 1 crore is the sale value, for 55 lakh is the cost. So whether the TDS should be deducted on 45 lakhs or TDS should be on 1 crore, that's the question. So gross or net is what we are discussing. Now here the decision of Karnataka High Court is saying it should be gross. Incorrectly applied the Supreme Court ruling in Transmission Corp, which requires obtaining 195(2) certificate to determine it if it is a composite payment in income in a composite payment. So it says that if you want to do net, then you need to get for 195(2) certificates. So that's one part of it. There's a second decision which is saying that deduction of tax at source should be limited to the portion of income chargeable to act, and that is the part of gross payment to the non-resident. So basically it is saying that it should be on the income chargeable under the act and not on the total value. So that's two. Third, tribunals etc all have been saying, and ultimately the Supreme Court, they did not consider Supreme Court ruling in G, which specifies that the tax should be deducted only the income portion and not on the total value. So there have been tribunals after the Supreme Court also who have said that it should be on the net value. Now this is one part of it. Now let me take you to the second part of it. The second part is there is an FAQ which is there from the department, which department FAQ is indicating. I'm reading the second part of the slide, which says that the department FAQ indicating that approaching the income tax department is necessary in every case of deduction under 195. It is not mandatory that each and every, this is the quoted statement which is there in the FAQ. It is not mandatory that each and every case is that should be obtained 195 to order before deducting TDS. However, in case of a complex issue, it is advisable to do so. This is because the liability of deduct a proper tax remains with the deductor, right? Instruction is saying that CBDT has directed AOs under 119 that in case where the assessee fails to deduct TDS, AO cannot treat the whole amount remitted to a non-resident as chargeable to tax, but he has to determine the appropriate portion of sum chargeable to tax under 195(1). So it is saying that the instruction is saying that if the deductor has failed to deduct it, that AO cannot deduct at a total value. Either AO has to identify what is the sum chargeable to tax. Now that is an indirect references which clearly is saying that in case if you are a deductor, you are supposed to deduct on the net value. But let me give a caution statement over here, because this is the structure which I briefed you. But there is a litigation and there's a gray area which is going around. But yeah, if you have deducted on a net value, because there have been a lot of share transactions which happens where you redeem the shares, the question is whether it should be on a gross or net. Let me answer this point. The answer is practically in largely in the share transaction, generally it is on a net value because you are able to have the cost directly available and therefore you can take the benefit of FAQ and instruction. Therefore, in the share transaction on a practical level, basically it is taken on a net value. And in the property transactions, when you are buying the property at that particular time, you go for 195(2) certificate. That's been the general practice or general practical things which is happening on floor. But I just shared with you what is the structure. So in case if somebody wants to have already not deducted tax or deducted at a net value, then they can take the benefit of this particular structure of the taxation which is available. But as a word of caution, please make a note of it that this is a gray area where gross or net is something which is a call to be taken by the deductor. Moving to the next point. The next point is, okay, foreign fluctuation adjustments. Now here, what is important to look into is that what is this example? Let us go with the example. The example is saying the cost is 65 and in USD it is 1000. So when you bought it, it is at 65,000, which is 1000 USD. When you sold it, it is 80,000, which is 1000 USD. So there is a rupee depreciation, as a result of which, though you made a profit in India, but ultimately in USD dollars you have not made any profit. So there is a gain, but that gain is in Indian rupees. There is no gain in the USD. So therefore, the tax in this particular case will be nil, because for a non-resident there is actually no gain at the end of the day when it is converted into USD. This is what the provision is trying to say. Now let's take one example. Let's take this example where what has happened is cost is 65 1000 in our example, 80,000, but the value has got appreciated. So as a result of that, though you made a profit which is lower as far as Indian capital profit is concerned, but from the USD perspective you made a higher profit. So ideally there has been two amount of profit. One is gain and second is another gain which is on the account appreciation, on the rupee appreciation. So there is two gains. One is capital gain and second is rupee appreciation gain. The question is, what is going to be the tax implication? The CBDT has issued a circular at the time of enhancement of this provision 3, which is saying the non-resident Indians who invest in India, who invest in shares, debentures of the company, have been representing that due to the fall in the value of the rupee, the foreign currency in which the investments were made by them, they are adversely affected when they sell the shares. In order to overcome that, Section 48 provision was introduced, proviso was introduced. Provision merely state that the capital gain is to be calculated in foreign currency. It does not mention that the conversion is to be done only in case of a devaluation of rupee. So what is important to understand here is that it is not saying that only do it when there is a devaluation of rupee. It is saying that you do it even at there is a appreciation in the rupee, right? So therefore, this particular methodology has to be applied, and at that stage you see that the additional gain is 50. So what is it saying? Does the taxpayer have an option to choose availability of this provision? So if I gain, if I make if there is a depreciation of rupee, I make I at a USD level, I don't make profit and I don't pay tax. Now the question is that when there is an appreciation, whether the same rule applies or not, or whether I have a choice to decide at that point of time whether I should apply this proviso or not. What is it saying? So it's saying is this proviso is applicable if the amount is reinvested. Okay, not reinvesting. Let's go first on this. Is this benefit available to shares or debentures gifted? So it says that appreciation also the same proviso should be applied. The rule is not saying that only when it's the depreciation the proviso should be applied. So there is no choice. It should be applied by the assessee as a mandatory provision, and therefore that has to be applied even in an appreciation and not only in depreciation. So the taxpayer smartly used to do it at the depreciation of the rupee to avoid taxation, and appreciation of the rupee they used not to do it. So the court is saying that at an appreciation also you are supposed to do it and you have to pay tax accordingly. Now, this benefit available to shares or debentures gifted or inherited, the proviso nowhere mentions any conditions for purchase of shares except for the fact that it should be out of the utilization of foreign currency. So if the money is utilized by in foreign currency, so if the buyer invests in forex, then the seller should also get the benefit, right? So if suppose there is a buyer who has invested in forex currency, and if then he has gifted, still the benefit should be available, the proviso benefit. So for example, if I am the person who bought it in foreign currency, I gifted to my son who is a non-resident, and now if he sells it, the proviso will still apply in this transaction because the original buyer have invested in foreign currency. Is a proviso applicable if the amount is reinvested? So let's say this 15,000 which we saw in this example, 15,000 and 25,000, let's say this is the profit and which has got reinvested. Now whether this proviso for a non-resident will still apply, the proviso states that the aforesaid manner of computation of capital gain shall be applicable in respect of capital gain accruing or arising for every reinvested amount. So that is what it is saying. So even in the reinvested amount, because now it is an Indian rupee, right, which has got reinvested by a non-resident, so there also whether the proviso applies, the answer is yes, it will still apply. Okay. Yes, I think that's what is about the cases. AIF joining to the group. So this is a group which is available for everyone. There are a lot of chartered accountants who are available on this group, and everybody is contributing to the queries which has come from different chartered accountants or practitioners or tax heads, etc. And this is a no nonsense group. There is no good morning, no good evening, nothing. This is purely for queries getting raised, and there are some of the other person in the group who answers the particular query. So anybody and everybody who wants to scan it across can scan it, and then we can move forward to the next part. Thank you. I think I'm done with my presentation. We are at almost at the time, and now we can open for question answers. Whoever wants to raise the questions can raise the questions, and I will be happy to answer these questions. Yes, can we open the floor for questions? Let me just see what questions are there so that I can answer those questions. So first question which is there for me is, what is the date of issue of bonus shares assumed in tax? Whether the date of original shares or when the bonus shares are actually issued. The query is regarding computation of capital gain. So the point is, when the shares are issued as bonus, whether the shares would be the date when the original shares were issued or the date when the bonus shares were issued. I think the date would be the date when the bonus shares have been issued, and that is the date which has to be considered. So that's number one. Let me see which are the other questions which are there. Just one second. Let me see other questions. No, I think I'm done with the part. I think though I don't see any questions. Ma'am, are you able to see any questions?
No, sir.
Okay, so I think then we are at 5:51, and if there is no questions, I may take this slide of AIF, and then maybe we can wind up.
Sure, sir.
Okay, can you see the screen, right?
Yes, sir. Yes.
Okay, so AIF basically, let me take this opportunity because there are limited questions. Let me take this opportunity on taxation of AIF. So AIF, we are aware of there are three categories: Category 1, Category 2, and Category 3 AIF. Category 2 AIF is basically where they are investing into unlisted companies, etc. And Category 3 AIF where they are investing into structured products. So we are aware about it. Now let's see what is the taxation. Taxation for Category 1 and 2 are given a special pass-through status where the income will be charged in India under the same head of income in the hands of investor, all along with the corresponding TDS credit in the home country of US. Now here what tax rate are applicable to NR investors, what income will be taxed, accrued or distributed. So here, let us answer this question. It says that if you are an AIF, category 1 or category 2 AIF, then the status of those particular AIF would be a pass through. So whatever is been the tax which should be there under the heads of income in the hands of investor, that is going to be taxed accordingly. And I'll also go on to the third category, and then we see the difference. The AIF3 is only a fund which is hedging, is not a pass-through entity. So AIF itself will pay the tax at the maximum marginal rate and then distribute the profit. So here what is going to happen is, what is the difference between category 1 and 2 and 3 AIF? Income is taxable in the hands of funds only at MMR if set up at an intermediate trust. If set up as an intermediate trust, then it is going to be taxed at a maximum marginal rate. What is the best setup for an NR to get invested into India? So investments into India is basically largely happening through a category 2 AIF, because there what is happening is it is going to be taxed at an individual level. Now when it is going to an individual level, it is going as a profit to an individual, and then from that whatever taxes is paid by an individual in India, he can take the credit of that taxes in US. Now, in category 3, because the category 3 AIF is paying the taxes, there is an issue or there's a question on whether the credit of that is available or not, which generally is a difficulty. But when it is category 2 AIF, individual pays tax in India, and in US example, they will be taking a credit of it because the taxes have been paid at an individual level. So that is something which happens when it comes to AIF 1, category 2 AIF, because it is having a pass-through status. Uh, Question is now whether it will be taxed on a notional basis. So is it accrual or distribution? Now in US, as we spoke about mutual funds, because the US is not categorizing or not considering this into that specified classification, therefore this particular profits would be taxed in US on notional basis. So that is one of the hindrances which is there, which should be taken care of when you are investing into an AIF, because that's where if US is, and that's what is happening, that in US this particular categories are considered into that classification, and therefore it is taxed on accrual basis and not on the distribution basis. And therefore the same problem which we spoke about year 1, year 3, wherein you are taxed in year 1 in US and you are paying tax in year 3 in India, that is the problem which statement will still continue. So this is one particular problem which is there, but otherwise it is a pass through status. So if there is a profit which is distributed, then that profit will tax will be paid by an individual, and then individual will further take a credit in the home country. Now there are structures available, so that can be always taken up independently, because they require a separate presentation on taxation on AIF. Right now, we are focusing at an overall level. Therefore, I'm just summarizing it, that if there is a redemption for category 2, it's a pass through. Individual will pay tax in India, and accordingly, he'll take a credit in US. Okay. And if it is category 3, it is the tax which is paid by the AIF itself, and there is no tax on the individual, and therefore no tax in US. So that's how this particular taxation will play as far as the AIF is concerned, right? I think let's conclude the presentation. We are well within the time. If there is any more questions, we'll take it up or we'll conclude it. I think I don't see any questions